Okay, picture the scene. It's Monday morning, January 26, 2026. You've got your coffee. Honestly, it's probably the third one of the day
Hmm.
because the screens are just lighting up. You can't look away.
Absolutely.
We're looking at the S&P 500 futures, the ES, and they aren't just drifting higher.
Oh, no.
They are testing intraday highs, sitting right at 6,964 baht 00.
It is an absolutely electric start to the week. And what makes this moment so fascinating isn't just the number, though. Let's be honest, staring down the barrel of 7,000 on the S&P is. It's psychologically massive.
Yeah.
It's the conflict bubbling just underneath the surface.
That's exactly why we're doing this deep dive, because if you just glanced at the headlines, you'd think the market should be stumbling. We have this massive weight, this bearish drag coming from a legacy giant.
Intel.
Right, Intel is.
It's in the dumps today. It's ugly.
But the market is looking at Intel, shrugging, and basically saying, I don't care.
Completely ignoring it.
Why? Because we have this phenomenon that sources are calling the AI overpower.
That is the phrase of the day, AI overpower. And honestly, it feels like a historic shift in how the market values, different kinds of tech.
So here's our mission for this deep dive. We're not just talking about a ticker flashing green. We're going to unpack a really strange moment where everything seems to be going up at once. Stocks, momentum, and here's the kicker that really confuses me.
Gold.
Gold is screaming higher at the same time.
Which is the paradox. I mean, textbook economics says you don't see risk assets like these AI stocks and safety assets like gold partying together. It breaks all the rules.
So we've got the expanded swing trader report right here. We've got the live CME group data. We're going to break down the who, the why, and maybe most importantly, the how of this rally. So let's start with a setup. That resistance at 6,950.
Shattered. It's in the rearview mirror.
Yeah.
Now we're in what traders call price discovery mode.
Define that for us. It sounds adventurous, almost like we're off the map.
It is adventurous. Think of it like a map where the edges are blank. There's no historical ceiling, no previous high to act as a reference point. The market is just exploring new territory, trying to find out just how much people are willing to pay for this AI narrative. It's pure supply and demand, totally unanchored by the past.
That is both exciting and, frankly, a little terrifying. So if we're exploring, we need to know who's driving the bus.
Yeah.
Because looking at the data, this isn't exactly a broad rally where every stock is joining in, is it?
No, and that's a critical distinction. If you look under the hood here, it is incredibly narrow. It's a Mag 7 rally, sure. But really, if you zoom in on today's action, it's mostly just two titans.
The big boys. NVIDIA and Microsoft.
Precisely. Let's look at the numbers from the report because they're just staggering for companies of this size. NVIDIA, ticker NVDA, is up 3.58%. It's trading at $188.37.
That is a massive move. I mean, for a company with a market cap in the trillions, moving 3.5% in a morning requires billions of dollars. That's not just retail traders.
No, that's institutions piling in. It takes a tsunami of capital to move a ship that big. And then you have Microsoft, MSFT, up 3.40%, trading at $466.22.
So when you have two companies of that magnitude moving more than 3%, they basically generate their own gravity.
They do. The sources describe them as effectively carrying the entire index.
Like the rest of the market is just drafting in their wake.
They are. And this leads us to the specific mechanism of what's happening. We have to talk about the short squeeze because this isn't just organic buying. This is buying born out of pain.
Okay, let's unpack the mechanics of a squeeze. How does that play into this Monday morning?
Well, think about the setup coming into today. You had traders, the bears, the skeptics looking at Intel. Intel is languishing down at $43.43. It looks weak. It's struggling.
Right. It's the old guard of chips showing cracks. And if you see a giant stumbling, you assume it's going to hurt the whole sector.
So the bears placed their bets. They shorted the market thinking, okay, the semiconductor sector is going to take a hit because of Intel. I'll bet against the index.
They were betting on what the report calls the Intel anchor. They thought it would drag the whole ship down.
Exactly. But they completely underestimated the AI overpower.
Huh.
When NVIDIA and Microsoft gapped up and just kept running, those bears were they were underwater, fast.
And in the futures market, you can't just sit on a loss forever. The margin clerk starts calling.
Right. To stop the bleeding, you have to get out. And here's the irony. To close a short position, you have to buy the stock back.
So the bears become forced buyers. They're not buying because they like the stock. They're buying because they have to.
Precisely. So you have the organic buying from people who love AI, plus you have panic buying from bears who are just trying to survive. That double whammy pushes the price even higher.
It's like pouring gasoline on a fire.
That's exactly it. The report says the Intel anchor has been cut loose. The market has decided Intel's problems are Intel's problems, but AI's success is the market's success. The divergence is absolute.
That's a really important takeaway. The market has completely decoupled old tech from AI tech. One can sink while the other one flies.
It's a changing of the guard, happening in real time on our screens. It's almost Darwinian.
Okay, so the bears are running for cover, the bulls are chasing the leaders. But here's where it gets really interesting for me. And frankly, this is the part of the deep dive that makes my head spin a little.
The macro picture.
The macro paradox, this idea of a dual bull market. Because usually I think of the market like a seesaw. On one side, you have risk stocks, tech, AI. On the other, you have safety gold, bonds, cash, if one goes up.
The other usually goes down. Risk on versus risk off. It's Finance 101. When you feel brave, you buy stocks. When you feel scared, you buy gold.
But today, the seesaw is broken. Both sides are up in the air.
It's a rare and powerful signal. Let's look at the gold numbers because they are just as vertical as the tech stocks. Gold futures GC are screaming higher, currently at $5,081.50. That is up 2.04% on the day.
Hold on. Let that number sink in for a second. Over $5,000 an ounce.
It's a historic level.
And it's up 2% on the same day that big tech is up 3%. That doesn't make sense. If everyone's so confident in AI, why are they also buying gold at record highs?
This is the decoupling. And the source material offers a really fascinating interpretation. It suggests we're seeing two different psychological drivers hitting the market at the exact same second.
What are they? Break down the psychology here.
Okay, for tech, for NVIDIA and Microsoft, the driver is pure FOMO, fear of missing out. Investors are chasing immediate alpha. They want profit now. They see the momentum. They want on the train. It's greed.
Okay, so that's the gas pedal. Get me rich now.
Exactly. But for gold, that's the fear part, or at least the caution. Traders are buying gold as a hedge against future risks.
Like what?
Maybe they're worried about the Fed or geopolitics, or maybe they just think stock valuations are getting so stretched that they need an insurance policy.
So they're betting on the boom with one hand and buying insurance against the bust with the other.
Yes. And doing both aggressively. It's what we call a barbell strategy. You load up on the highest risk and you load up on the safest, and you just ignore everything in the middle.
What does that tell us about the financial system right now? Because to me, it sounds like people just have way too much cash and don't know where to put it.
It tells us there is massive liquidity, just so much money flooding the system that it can afford to inflate everything at the same time. It's a sign of irrational but incredibly powerful momentum.
It's like a tide that's so high, it's lifting the luxury yachts and the life rafts at the same time.
That is a perfect analogy. And as long as that liquidity is there, you do not want to stand in front of it.
So we have the AI titans, we have the what, this dual bull paradox. Now let's talk about the how, the mechanics. The report mentioned something about rocket fuel coming from the bond market.
Yes, you have to look at yields. You can't understand a tech rally without looking at the 10-year. The report highlights yields are at 4.22%.
And they are down slightly, right? Down 0.02%.
Correct. Now, to the average person, that sounds like a rounding error. It sounds like nothing. But in the world of high-frequency trading, the direction matters more than the magnitude. Falling yields are rocket fuel for tech stocks.
Remind us why that connection exists. Why does Microsoft care if the 10-year yield drops 2 basis points?
It comes down to valuation. Tech stocks are what we call high-duration assets. A lot of their value is based on earnings that will happen years and years in the future. AI profits in 2030.
Okay, so we're valuing future money.
Right. And when yields go down, the discount rate you use to calculate the present value of those future dollars also goes down. It makes those future earnings worth more today.
So falling yields basically act as a green light for the trading algorithms to just buy.
It's a signal. The algorithms see the yield drop and they instantly hit the buy button on the NASDAQ.
So the bond market gave the green light.
Right.
But I want to get into the visuals from the Larry Williams style analysis part of the report. This caught my eye. It talks about the shape of the candles on the chart. It mentions something called Marubozu bars.
Yes, the Marubozu.
Sound like a martial arts move.
In a way, it represents a kind of martial aggression in the market. It's a term from Japanese candlestick charting.
Okay, break it down for someone who isn't staring at a chart right now.
So a normal candle on a stock chart have a body, the thick part, and wicks, the thin lines sticking out the top and bottom.
Right. The wicks usually show hesitation, like the price went up, but sellers pushed it back down a bit. That creates a wick.
Exactly. A wick represents a struggle. But the report says the 15-minute candles today are Marubozu bars. That means they have little to no wicks.
So just solid blocks of green.
Solid blocks. It means the price opened, went straight up, and closed at the absolute high of the period. It indicates that institutional buying programs are just hitting the ask price without any hesitation. There's no pushback, no second guessing, just buy, buy, buy.
That paints an intense picture. It's not a drift upwards, it's a march.
It is vertical momentum. It tells you the buyers are in complete control and the sellers have left the building. And that is being reinforced by something called the gamma squeeze.
We hear about gamma a lot these days. It sounds super technical, but it's driving so many of these moves. Break it down for us.
Okay, so imagine you're a market maker. You're the bank. Your job is to sell options to traders.
Okay, so I'm the casino selling lottery tickets.
Right now, everyone wants to buy call options on NVIDIA and Microsoft. They're betting the price goes up. You, the market maker, you sell them those calls. But now you have a problem.
Because if the price does go up, I lose a ton of money paying out on those tickets.
Exactly. You are on the hook. So to hedge that risk, you have to buy the underlying stock, or in this case, the index futures.
So if the market goes up, I make money on the stock I own, and that offsets what I lose on the options I sold.
And here's the feedback loop. The market makers buying the index pushes the price up, which makes the calls more valuable, which then forces the market makers to buy more of the index to stay hedged.
It's a self-fulfilling prophecy.
It is. The report calls this a positive gamma environment, and it notes that as we clear 6,960, volatility actually compresses. So instead of choppy, violent moves, you get this steady, relentless grind higher. It's like a steamroller.
That explains the confidence in the report. It's not just a gut feeling. It's looking at the plumbing of the market and seeing all the pressure flowing in one direction.
The plumbing is dictating the price.
So if the plumbing is pointing up, let's talk strategy. The report has a master trading plan. We're at 6,964 right now. What's the play?
The status is officially breakout mode. We had a bull flag pattern earlier, which is like the market catching its breath, and it resolved to the upside. Now the strategy is targeting the high day.
Okay, so what's the trigger?
The report identifies a clean break of 6,965 as the trigger.
Which is just 1 point away. We're knocking on the door.
Right. If we break that, the target is the 6,980 to 6,985 zone.
Why stop there? If we have all this momentum, why not aim higher?
Well, the sources talk about a gravity well. The market is just magnetically drawn to big, round, psychological numbers. And the biggest number on the board right now is 7,000.
7,000. That is a massive milestone.
It is. Humans love round numbers. When you get this close, within 20 or 30 points, the market almost wants to go there. It pulls price toward it.
It becomes a self-fulfilling prophecy again. Everyone thinks it's going to 7,000, so they buy, which pushes it to 7,000.
Exactly. But every good trader needs a safety valve. If we buy the breakout at 6,965, where do we get out if we're wrong? The stop loss is set at 6,952.
That makes sense. That's back below the breakout point. If it falls back there, the breakout failed.
Exactly. It's a tight leash. You don't want to hold on to a losing trade if the momentum breaks.
Now, speaking of which, are there any warning lights on the dashboard?
There is one yellow light, the RSI.
The Relative Strength Index.
Right. The 15-minute RSI is pushing 68.
And generally, 70 is the cutoff for being overbought, right?
Conventionally, yes. In a normal market, when RSI hits 70, you expect a pullback. But, and this is a huge but, the note in the report is very specific. Do not short it.
Even with the RSI that high.
Especially with the RSI that high in this kind of squeeze. See, in strong trending markets, the RSI can stay overbought for a long, long time. It can pin at 75 or 80 while the price just keeps climbing.
So trying to short a vertical market just because a line on a chart says overbought is a trap.
It's a classic way to lose money. The trend is your friend until it bends. And right now, looking at those Marubozu candles, it is not bending.
The pointing straight up.
It is. The bias is aggressively long. Do not stand in front of the steamroller.
Okay, so let's recap the story of the day. It's January 26, 2026. The bulls have won the morning session.
Yeah.
Unequivocally.
They have dominance. They took the Intel news, which should have been a heavy anchor, and they cut the chain.
Microsoft and NVIDIA are doing the heavy lifting, both up over 3%.
Driving that short squeeze and forcing the bears to capitulate.
And gold is signaling this massive amount of cash, sloshing around, hedging for disaster while betting on the moon.
The dual bull paradox. It really is the defining feature of this market cycle. It shows a market that is rich, aggressive, but also deeply paranoid.
And the verdict from our source material is clear. The bias is long while we're above 6,950. We're looking for that break of 6,965 to ride the wave towards 7,000.
That is the trade.
It's incredible to think about. 7,000 on the S&P. I remember when 5,000 seemed like a fantasy.
Markets have a way of humbling our expectations, don't they? They go higher than we think possible and fall lower than we can imagine.
They certainly do. Before we wrap this deep dive, I want to leave the listener with a final thought. We talked about this paradox, investors buying gold at over $5,000 an ounce to protect themselves.
While simultaneously buying stocks at record highs.
Right. So here's the question. If the smartest money in the room feels the need to buy that much insurance, do they know something about the durability of this AI rally that the rest of us don't?
That is the question, isn't it? Is this the peak of confidence where we truly believe the AI revolution justifies any price? Or is this the peak of hubris, where we're just throwing money at everything because the music hasn't stopped yet?
Buying the breakout and the bunker at the same time. It's a bold strategy.
It certainly is, but for today at least, the price is going up.
And that's what matters for the scoreboard. Thanks for listening to this deep dive. Keep your eyes on those charts. Watch that 7,000 level, and we'll see you next time.
Stay curious.